Well, good evening. Thank you for tuning in to Un Poco Mas, the show where we give you just a little bit more. My name is, of course, DannyDealz, the infamous, the one and only. I would like to thank my executive producer, Hurricane Lopez, for producing the show today. I got a question on Stocktwits. Actually, a user, Thomas or Tomas, seemed like it could have been some kind of euro off of the SoFi board, asked me to take a look at Carvana and see if I thought it was going to do one of those short squeezes. That's where smart money shorts the hell out of the stock, and then some clever Reddit army or retail investors or YouTube army or whatever you want to call them sort of coordinates a time, and or it can happen organically, I suppose, and they just start buying the stock, and the price jumps up unexpectedly, and the short position is caught unawares. And once they're caught unawares and that price starts going up, the shorts have to, of course, start covering quickly, which just drives the price up further and further. They have to cover at ever higher prices. Tough decisions are made. People in corner offices are fired. Oh, it's carnage. And retail celebrates. And, we all buy G Wagons and yachts and crypto and mansions here and there. But in the real world, short squeezes are actually a lot more rare than people think. GameStop and some of these AMC things. These are unique situations, and these were a lot of retail investors very engaged. Particularly during the COVID pandemic, when everyone was home on their computer, they had 12 to 18 hours a day to smoke bong loads and surf Reddit for that next coordinated effort. I just don't think there's going to be another GameStop, and I certainly don't think it's going to be Carvana. Um, the way I invest is I don't mind looking for a company with high short interest, but only if I think that company has merit anyway. Only if I think the share price is undervalued. I'm never just looking to trade a chart or to trade a company based on the short interest. Usually, not always, but usually, a company has high short interest for a very good reason, and that is because they are dog poo, and they are going to zero. And, the hedge funds and stuff are happy to hurry that process along and make some money off of us retail investors. But generally speaking, great companies are not shorted. There are one or two exceptions. I am a SoFi investor. I like the company that had very high short interest, like 20% at one point. It's come way down, but they looked a little bit shaky. Anyway, it just doesn't seem to happen that much. But let's take a look at Carvana. Let's see what's going on with this stock. First off, Carvana is a used car dealer at the heart of things. There was a company called Drive Time. I think they still exist, and basically the owner's son had come in and looked at all this new technology and analytics and machine learning and all this stuff, and he wanted to revamp the used car buying experience, and that's how Carvana was born. And the company grew extremely rapidly, their sales up to like $10 billion a year, and it was a smashing success. The problem was they never made any money, and they had thin margins. I mean, I haven't looked in detail at their financial statement. I just got this question, did a little bit of research. So if you want to correct me, please do so down in the comments. Please share any thoughts you have down in the comments. I don't claim to be any type of expert on Carvana, but I got the question. I said I'd take a look at the stock. Um, the problem is they were known for giving good terms and good prices, and that means thin margins. And I mean, the used car business is already a tough business. You've got a lot of competition. You're competing with not only like the new car market, but with private party used cars. You're competing with leases. You're competing with like car sharing services. You're competing with people now who just want to do like Uber and Lyft. And with the economic pressure from the pandemic, you're competing with, public transportation. So, people that are looking to buy from Carvana, they're not buying new cars. They're looking to save some money. They're price conscious. They're interest conscious. And, we all know where interest rates and the used car market just went insane there for a little while during the, microchip shortage and all the supply chain problems. But a lot of that's been sorted out, and demand has crashed just because, the interest rates are so high. People are just holding off on those large purchases, and they have sticker shock at the payments. And people, I don't think, are willing to just, come in and take $700-800 car payment on a basic used car and hope that they can refi that later when interest rates come down. That's just foolhardy. So let's just take a quick glance at the chart and just make a comment here that COVID. I I hesitate to say this, but COVID like made companies shoot up, and they just brought craziness to the market. If you see going out here like 2018, when this stock was trading like 20 bucks, you see this line here. Nice gentle slope up. This is fast growth, but it's somewhat sustainable growth. The slope of this line, you would have, instead of being at like 300 something, you would have been closer to 150. And it just, this line is sustainable. I mean, every investor can understand that it's a very fast growth trajectory, but it's a sustainable stock price increase if a company is like hitting it out of the park. Now, this, on the other hand, you see this angle down, of course, the beginning of the COVID pandemic, and then this stock increased, as fast as like Tesla or any of those like super, perhaps, what are some other examples? Zoom, Teladoc, because people were staying home. People weren't going to go to the car dealerships anymore, and you didn't know if they were ever going to come back. So you just see this stock come up off of this $20 level of where it caught support, caught some buying pressure after the market did that whipsaw reversal after the beginning of the COVID pandemic, like first, whatever it was, 30 days, everybody panics, the world's going to end. And then right after that, we just have this massive rally. The government, starts pouring money into the economy, ensures everybody's going to get all these unemployment benefits, cancels student loans. There's just this flood of liquidity into the market. And of course, all of us geniuses decide we're going to be stock traders. We're going to, so then of course, as all of this kind of, starts just going up at a fever pitch, reaching this froth that's just completely unsustainable, people buying on FOMO, taking profits, and then this is where, the smart money starts selling the stock and baiting, retail to keep buying the stock. And, people are buying this stock up here in the 300 range, and it's trading, went all the way down to like $5. But you see the slope of this line from here to here, from March 25, 2022 down to mid-May 2022. That line is just as steep as the COVID decline. It's almost identical, but the difference is where you get this immediate bounce. There's no bounce here. You have the same level of support at 20. You found a little bit above that, and you had it back here. That's not really support. That was actually coming up through 20. But you find support here again at 20 bucks, right around that $20 area. You trade sideways basically for a couple of months, 2 months, and then you have this little rally up to 50 again, which is, very nice rally. And then from there, the stock has just sold off all the way down below $5. Rallied again, tried to test this $20 level where it had been support, and that actually became resistance. So where you had always had this buying pressure above 20 or at 20 here, and 3 times you saw it bounce off of 20. Testing that triple bottom, going back up to 50, you think, oh, we're in business. Hallelujah. Carvana's running again. But nope. This was a complete pump and dump. The smart money slammed the door and left a lot of bag holders. And we had another little rally here of late. And then, of course, the stock has sold back off under the $10 level. A little bit of a bump today, 21 cent increase, or 2.26 points, up another big penny after hours, or 0.11%. So the stock sits at $9.51. It tried to break through $20 here on February 6, 2023. It failed miserably. And, unless it can break through $20 decisively, this stock is not going anywhere, even with the huge short interest. Now, why don't I believe you should trade for short squeezes? The market makers are on to this. They're covering these positions. They're monitoring Reddit. Now the whole thing with GameStop is this: Wall Street did not see that coming. Obviously, they got caught with their pants down. Um, they had to freeze trading on these things, on these stocks, just completely unethically. I believe the platforms, made these excuses to freeze the stocks, basically to keep hedge funds from going bankrupt, going out of business. Their losses were just going up and up and up. So they pulled these, circuit breakers and essentially screwed the Wall Street bets crowd. But anyway, this stock, it has the company. This is not, a fluke thing. How all the like SPACs and things sold off. Most of them did not sell off. Like, some of the stocks, like I said, like Neo, it was up like, $50 and has fallen back to like $8. That's a hell of a decline, but it's not 300 to 5. This stock has seen the extremes and it's just not going back to those highs. I would be surprised if the stock ever breaks $20 again. If it does, it will be on the basis of some kind of a short squeeze, some kind of a pump and dump. But I just don't see the fundamentals of this stock recovering. That's my opinion. This is just a couple of articles. This one's in the Motley Fool, March 29. Motley Fool, of course, churns out a lot of crap, but this is basically talking about the debt. I mean, from one year to the next, their interest on their debt went from 50 million to over 150 million dollars. Their advertising expenses are like $500 million a year. I mean, if you're really looking at these books carefully, maybe it wasn't the time to spend like $20 million on a Super Bowl ad for 30 seconds when you're not even making money on the unit economics of the widget you're selling. But they're trying to get out from under this debt any way they can. Um, but it's just not going to work. They're doing it, but at what cost? It's destroying their credit, but they're just trying anything they can to stay out of bankruptcy. People are like, well, they have 700-800 million dollars in cash. Well, I mean, fine, but they're losing. Of course, Q4 they had a huge loss, like 800 million. That was on a goodwill write down, I guess. But you know, they're just there's nothing there. There's no viable path forward that lets this company get its fiscal house in order. And, they just announced this debt swap, which I think, the announcement got a pop in the stock price. Um, I guess that was like here, or maybe it was about a month ago, 2 months ago. I'm not sure exactly when they announced that. I think that pop was for something else, actually. But let me see. Yeah, of late, yeah, we just came up $10 again. Can't even break through 10 at this time. That's kind of the new. That's been resistance. Catching a little support here. At 10, caught some support here, and then we've the stock has failed at 10 3 times here on March 3rd, March 22nd, and then again just a couple of days ago. So we're talking about breaking through 20, which is historical pivot point for the stock, but right now we've tried to test 10 3 times and haven't been able to get through. So any bulls here, any short squeeze people need to see, this particular trying to draw a line here. I can't do it for some reason, but need to see this continue basically, because we've we've got some support here, and then you know you've got sort of the makings of a triple bottom, 1, 2, and 3 over a very short period of time at about 750. Then you have to break through that $10 mark so you can challenge that $20 mark, and it's off to the races from there. But folks, that is a pipe dream. This company is buried in debt. They just tried this debt swap, and S&P says it is tantamount to default, and they cut their credit rating because, or the rating on Carvana's debt specifically to from CCC plus to CC with a negative outlook. I'm not, I know A is good credit, triple A. So going from CCC plus to CC sounds like a pretty bad deal. And there's potential here, they note, to raise the ratings to a level that reflects the risk of a conventional default or future distressed restructurings. Um, they go on, Carvana is pursuing the deal because its capital structure, and listen to this quote, is unsustainable, and the company has limited options to reduce its debt burden and improve its cash flow organically. Organically. That means the business doesn't work. They're essentially playing accounting and financing games to try to stay afloat, and probably so the owners and the executives can, bilk the shareholders or the credit holders, the bond holders, out of some more money. That's usually how these things go. They try to get out with everything they can, just try to keep collecting their salaries, and obviously the stock options are not, any prize at this point. But there you have it. This is my opinion on Carvana. I'm not seeing it, folks. The There's a lot of buzz around the stock right now, and there is some buying pressure coming in at $7.50. I think this stock is going to continue to struggle to break through the $10 mark, and even if it's able to do that on just some, a lot of internet hype, I just don't think the stock can break 20 bucks, and I think this thing is a big loser, and it's going to zero, and I don't think it's a smart thing to just look at short squeezes if there is not underlying merit to the company and the stock itself, and you don't believe this. Only buy stocks you think are undervalued. That's just the bottom line. Only buy stocks you think are undervalued. Don't buy stocks because you think it's going to be a short squeeze, or you think the chart looks a certain way, or you think earnings might be a certain way. Invest long term, and buy stocks that have merit. And if you get a one that happens to have a lot of short interest illogically, and you get a short squeeze and you make a bunch of money, you make a big lick, more power to you. God bless. But this time I cannot recommend Carvana, short squeeze or otherwise. I think this thing is a big turd, and I would not recommend you buy it, Tomas. So thank you for your question. I appreciate it. Big no on Carvana, ticker symbol TVNA. That's my opinion. My name's DannyDealz. Thank you for tuning in to Un Poco Mas, the show where we try to give you just a little bit more. For executive producer Hurricane Lopez, good night.